So, welcome back. We're on Chapter 4 now. You'll be very happy with Chapter 4 because it covers, I think, every topic, something you have looked at in introductory. And all we're doing now is taking it to the next level and adding in some little details. So, you should be able to rest on what you already know. Now, normally in class, I'd say, how many of you remember all these statements and how to put them together? And usually there's a few, but most people are quite freely admitting that what they learned last year in the first semester is kind of gone. So we will do a little bit of review as we go along, so don't worry too much. So this covers the statement of financial performance. Don't get it mixed up. Statement of financial position or balance sheet, as we're using it, the SFP. This is a new name for the income statement, so we can think of this. In fact, I'm going to call it the income statement if it has no OCI, and statement of comprehensive income if it has OCI. So those are the two separates I'm going to talk about that record profit and loss. That's another thing this is called, profit and loss statement. So if you see P&L on some statements, that's what it means. We're also going to cover the statement of changes in equity and the statement of retained earnings. Discontinued items might be new. You might have already seen some, depending on which order you took. And earnings per share. Appendix A is a nice review of the difference between cash and accrued, but it's not required. The other thing about earnings per share is we are just doing base earnings per share. In 316, so the second intermediate, you'll do diluted earnings per share. So it'll build on this. Net income. You can read about this. Remember, it's a period of time, so for the quarter ended March 31st or whatever. So we're looking at profitability, investment value, creditworthiness, the amount, timing, and uncertainty of future cash flows. So we can look at the past performance and determine the risk of achieving particular cash flows. Now, while it sounds all well and good to have a nice income statement in front of you, there are definitely limitations. Items are excluded if they can't be measured reliably. So we'll look at different scenarios, for example, in a construction project, to see things like this happening. Amounts reported are by accounting methods used, so of course, if you're using different accounting methods than other people in your industry, or other companies, then you're going to get different kind of results. Use of estimates, as we all know, in measuring income. We talked about that in Chapter 2. Financial reporting bias. So there's two things that can affect that. Management or the executive team. I can't spell. Let's try that again. Executive. And the accounting stance biases. For example, before IFRS, we just use Canadian ASPE, and all the firms use the Canadian, unless you're being traded on a different stock exchange that use theirs. But the accounting standards were heavily biased to be conservative and pull assets down, pull revenues down, increase liabilities, increase expenses. So IFRS has moved from that to more objectively and reliably measuring those amounts instead of just always putting it the low number. And looking at GAAP shortcomings, like we said, there's the trade-off between what are those two standards, the qualitative characteristics, the big one, relevance, and representational faithfulness. Okay, another thing is we've got to talk about quality of earnings. So, how representationally faithful earnings numbers are. So, you've got to consider the content, the integrity of the information, how sustainable are the earnings. And the presentation we've got to look at. So, content, presentation, characteristics. Clear and concise, easy to use and understandable. Now, with both of these, there have been companies over the years who, like for example, Nortel, and some they're in trouble. Sometimes it's just how their accounting is and needs to be changed. They would send out restatements. So they'd send out their annual report with their audited statements, but then later on they'd find out there was some error in what they did or whatever, and have to restate and their earnings and re-present it to everyone because of a material error. So some of them you'll see do it multiple times, and sometimes it's just, changeover of management or something like that. Other times it can just be it's not well managed, let's say that. Now, characteristics of high quality earnings. Nature of the content. It's got to be unbiased, represents reality, reflects earnings from ongoing core activities. We separate gains and losses and other income and expenses that are incidental. And that's from Chapter 2. Can be correlated with cash flows from operations based on sound business strategy in the model, which is why we want you and make you as accountants, all of us, learn business strategy. Presentation doesn't disguise or mislead, so they're transparent. And as we talked about in MD&A, sometimes it's hard to achieve. And they're understandable. Now, earnings management, which is targeting earning levels and then working backwards to ensure targets are met based on the accounting. So changing your accounting. So it could be accounting policies. Decreases the quality of earnings. Users should assess the quality of earnings before making decisions about investing, loans, that kind of thing. So moving on to page 2. Comprehensive income versus net income. Comprehensive income is all-inclusive, and it's IFRS. It includes shareholder transactions that cause a change in equity. And you can just read the examples. Comprehensive income is net income plus or minus other comprehensive income. And this can actually be a separate statement under IFRS if companies want to do that. Now, we have to remember revenues and expenses, gains and losses are closed to retained earnings. However, OCI accounts, and they'd be listed as gain on investment, and generally they would have OCI after it, is closed to a balance sheet count like retained earnings, but it's called AOCI, which is accumulated other comprehensive income. ASPE focuses just on net income. So we're going to do an example to try and get the income statement straight. So, Whispering Winds Company reported the following for 2020. Net sales. Oh, and with these examples and in the text, if it doesn't give a year end, assume December 31st. Net sales revenue. Now, you may not remember from last year, but that's sales minus sales discounts minus sales, returns, and allowances. Cost of goods sold, selling and admin expenses, gain on disposal of building. Remember, that's incidental, so that's going to be separated. Unrealized gain, OCI. And that's FVOCI investments. We're going to do a whole chapter on that later, but for now, just understand there's that. Assume investments are accounted for as VOCI investments with gains and losses recycled through net income. Prepare, and don't think about this right now, we'll talk about this later. Prepare a statement of comprehensive income. So as we know from the previous page, comprehensive income is regular net income and OCI tacked onto the bottom, so you get comprehensive income. So, ignore income tax and earnings per share. So, our statement, well, you know what? You go ahead and putting this together, or at least read it again, make sure you know what all the pieces are. I'm going to run out of time in a couple minutes. I don't want to cut this example in half, so I'll start a new recording starting with this example.